What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to talk a little bit about the markets and why we are now starting to break down below some very critical support levels and moving averages. And not to mention the market is now starting to really rotate out of big tech over to some of the other parts of the market and sectors as well. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. That's all I'm asking in return, is that you subscribe and drop a like. I would really appreciate it. Links to our Discord and Patreon is going to be down below. And again, if you have any questions whatsoever, just reach out to me, email me, message me on Discord, and I'm always available to help as much as I can. And there's 16% annual discount that's available till the end of this month. There's about 4 more spots I think that are left. I opened up a couple more spots before the end of this month. Again, you'll get access to all the members only private videos, trading view charts, everything's going to be included with the link down below. So first things first, let's talk a little bit about where the S&P is. So we are just a little bit over 4,100 right now. So, as of the most recent data, so we are at 4,151. So we're getting a little bit of a bounce back higher, but still down about almost 1% on the day. And the most important piece here is that we are already accelerating that sell-off below the 200 simple moving average, right? So if you take a look at the 200 SMA, that's the blue line on the chart. We broke down pretty much here. And since then, we have really just accelerated that selling pressure to the downside, 2 back-to-back really brutal red candles coming in. And we continue to make this lower high and lower low pattern, right? This is something that we have been talking about on the channel for quite some time. And this is the lower low, this is the lower high, and it's very much in a downtrend at the moment. Now, Nasdaq had some hope going into today. Unfortunately, it broke down even further. So I did a short on this very concept, and it quickly aged out because, well, this is the breakdown, right? So we were talking about that 200 simple moving average at 12,750. And today the Nasdaq's down a little bit over 1%, I think. So we're down 1.4. At one point, we were down close to 2%. But we're bouncing off of that support, which, again, I'll come back to in just a minute. But this is the big sell-off and the breakdown that we're witnessing for the Nasdaq. So bottom line is that we are, once again, very much in a downtrend of lower highs and lower lows for the Nasdaq as well. Something, again, we have discussed in our previous videos. So none of this should really be surprising to all of you, right? If you've been following the channel, if you've been following our analysis, you guys have a very good understanding that where the trend overall is. We're trading against, a very significant amount of selling pressure and supply as sellers continue to kind of exhaust the market to the downside, and we are trading in this downtrend. So now, if you take a look at the heat map, right, it should give you a very clear understanding on where the money's coming out of, right? What's the liquidity getting sucked out of and where it's going. I mean, you've got a day like today where Microsoft, Apple down over 3%, right? Nvidia's down almost 4%. Google's down almost 3%. Meta's down over 4%. Amazon's down over 2%. Tesla's down over 3%, right? AMD's down over 2%. So there's a lot of big tech. I mean, especially if you come take a look at this watch list, right? It's all red, and there's just, a lot of companies that are just selling off. So again, we're going to scroll down a little bit on this watch list. And again, these are all trading view charts and watch lists that are available through our Patreon. So you can access that through our links. But basically what I'm focusing on is fragments here, and more specifically the index that I've created, right? This is all the Magnificent 7 companies down 2.6% on the day, or almost down $45. If you click on this, we've done the analysis on this in more detail. So if you come over to the analysis on that, you'll notice that this right here is the breakdown. Now, for the Nasdaq and for the Magnificent 7, I would still argue that it's still within trend, meaning that it hasn't seen a pretty significant breakdown. I mean, from an aggregate basis, we are still coming down to that 200 simple moving average, which is going to be sitting roughly at 1523. But I do believe, and look, nobody can time the market, and that's totally correct, right? I'm not here to time the market, but what I will tell you is that from a technical perspective on the long side, the risk reward is starting to get better, right? So if you take a look at the volatility and where it is at the moment, we're at over 20, right? So up over 3% on the day. We got up to as much as 22, almost 22. You guys know that we're watching 30 as a very critical threshold for the VIX. We get into the 95th percentile as soon as the VIX gets over 30. Historically and statistically speaking, that the risk reward is very much in favor of the long side. So those are some things to wait for. But even in the meantime, I think there is an opportunity on the long side considering how brutal this sell-off has been. I mean, this index is down 12% from its recent highs, and from its all-time highs, we are now down a little bit over 14-15%. In fact, we almost pretty much got up to the same high as before before selling right back down. Now, some people might call this a double top, which I guess is totally understandable given how exactly perfectly aligned we are compared to back in November of 21. But you can also argue that this is a little bit of a bull flag, and this is kind of like the downtrend of a lower high and lower low. And if we do start to see that technical rally back higher, it's possible that we do start to see that breakout back to the upside, but that's obviously going to depend on interest rates and where the macroeconomics basically take us. Now, if you come back over to the analysis here, another place where the liquidity is going to is bonds, right? So bonds, we've been talking about this. TLT is up over 1.2%. You've got LQD, which is investment grade corporate, up over 0.5%, almost back up to $100 a share. IEF is also, I believe, 7 to 10 year treasuries, right? So that's also the treasury market, which is up a little bit over 73 basis points. And we got USIG, which is, I think, US investment grade corporate. Once again, I think this is large cap corporate, and this right here is, I think, overall US investment grade corporate. So both of them up 0.5%. And SHI is going to be your short-term duration, 1 to 3 year bonds, up 20 basis points. Now, look, these are not big changes, right? These are not like you can say, oh, money's flowing out of tech, going into bonds substantially, but it represents that liquidity is indeed coming out of equity, and more specifically from big techs, and they're getting more defensive, right? Markets are getting more defensive. Investors per se are getting more defensive because they are moving out of tech and over to some other parts of the market, including, but not limited to, defensive companies and real estate and even basic materials, utilities, and even some of the financial services like Bank of America, Wells Fargo, Charles Schwab, right? All these companies are higher on the day today, including bonds that are pushing higher. So there is a little bit of that rotation taking place. And what's also interesting is if you take a look, right? And this was kind of very, very exciting to look at, was that if you take a look at this index, right? If you come over to the daily chart, this is S&P 500 stocks that are trading above their 50-day moving average. And what is one thing that you can notice right now? What you'll notice is that we are 14.3%. But just a few weeks ago, if you come back to October 4th, in the beginning of this month, we were at 6.4%. So in other words, at one point, there were over 94% stocks that were trading below their 50-day moving average. 94. And right now, there's 86, right? So there's about 8% stocks fewer that are trading below their 50-day moving average, and yet the market is hitting a new low, right? How does that make any sense? Well, that's because the stocks that are leading the move are the big tech, right? The stocks that are actually moving lower are the big tech. The previous sell-off was broader based, like it was more broad-based, right? It was participation from all companies, right? That's why a majority of stocks were trading below the 50-day moving average. And the fact that now there's fewer companies trading below the moving averages and the market's still hitting a new low, right? It's because it's the market waiting and the fact that big tech is the one that's leading this move lower. And again, kind of think about it from a liquidity standpoint. Why would big tech be leading the move lower? Because there's liquidity coming out of big tech because they're the best performers, and Magnificent Seven have really, just rallied in 2023. So money's coming out of those sectors or stocks, and they're moving over to bonds. They're moving over to maybe even cryptos, and they're moving over to other parts of the market. So it's really just rotating out of those sectors and moving into other parts of the market. So that's where we are. And I wanted to I'm going to do a quick video kind of explaining this whole phenomenon, but I think technically speaking, maybe there is a possibility. Again, there's no guarantees in the market, so none of this is financial investment advice. Please do your research and analysis and due diligence on the markets and individual stocks. But like I said, I think from a risk-reward standpoint, there is opportunities here, but of course they will only get better as the VIX continues to spike, as the markets continue to come down. So as prices come down, risk comes down with it. So hope you guys enjoy this video. This right here is just Goldman Sachs analysis. They basically mentioned higher and hold yes, higher and hiking no. That simply means that, given how strong the GP numbers were, they expect the interest rates to stay where they are. Basically the Fed not hiking anymore, but keeping them where they are at the moment. So always happy investing, and I'll see you all in the next video.